So good afternoon, everybody. We are very pleased to welcome you at AXA UK for the earnings release, for the full year 2008 earnings release. Presenting today will be Henri de Castries, CEO, Denis Duverne, CFO, and Gérald Darlin, Deputy CFO. Henri, the floor is yours.
Thank you, Etienne. Good afternoon, everybody. We know these are challenging times. We know you all have a lot of questions, but I think we should be respectful for the ones who are, I would say, listening to this conference through the web, and we will go through the presentation extensively but crisply to make sure that we leave as much room as possible for your questions afterwards. So, where do we stand, and what are today's key messages? And I fully understand that in these very turbulent times, sometimes it's difficult to get the messages listened to. But we will try with Denis and Gérald to, I would say, have you find the answers you are looking for. Two things, a little more than two things in 2008. First, it's absolutely clear to all of us that this was a year of extreme pressure. And in this year of extreme pressure, of course, we have not been immune. There are parts of the company where we have suffered. But overall, if you look at the earnings performance, I think we have resisted quite well to the turmoil. And the earnings which are coming out today are very much aligned with what we had told you in November. 4 billion of underlying earnings, it's less than what we had hoped for, of course, at the beginning of the year. But if you step back and look at what the historical sequence has been, it's back to the level of 2006, which was the second best year ever for AXA. So it's a resilient performance, even if the structure of these earnings is different from what it was before. And you should not ignore the fact that in property casualties, this was an absolute record year for the group. This business is very, very profitable. This business is a sort of ballast for the group, and we think has still good perspectives. Second important point, yes, the life and savings and the asset management business have suffered, but if you look at the cash flows, they are still very strongly positive, which I think is a very important element in these markets. The net income is very significantly down, approximately 80%, but the net income was impacted by what we see as being non-economic mark-to-market accounting rules, especially the fact that we had to take a sort of 1.6 billion hit just because of the widening of the corporate spreads. You know that the accounting rules on the insurance sector are slightly different from what they are in the banking sector. There has been, I would say, no reclassification in the insurance sector. Looking at this corporate portfolio, we think that this is going to be largely an accounting as opposed to an economic thing. Third key message, we are taking all the necessary actions to preserve the profitability and the development of the group in the long run. I mean, as a management, there are things we can influence and there are things we cannot influence. And complaining from morning to night on things you cannot control is useless. We are there to act and to manage, and we are acting and managing to mitigate the risks, to create productivity, to change the pricing of the products when they are inappropriate, I mean, to de-risk the balance sheet, and believe me, we are quite active there. Which, and this is the third message, makes us confident that the model is going to resist in 2009, even if 2009 is starting as a challenging year. What we are seeing in the world is very disturbing for a lot of people, but the world will not come to an end. So the key point for us is to make sure that the operating model is the right one, that even if impacted by the current turmoil, it's going to resist, that the balance sheet is safe, and that the day where things are going to calm down, we are going to be well positioned to benefit from the rebound. That's what we are doing. And we are going to try to convince you about that in the course of this presentation. Very briefly, I don't think you need to be convinced that 2008 was the perfect storm. How have we been affected? Clearly, we've been affected through the extreme equity market volatility. This is visible on all the variable annuities side of the business. The increasing cost of the hedges was high for us in 2008. This has led us to some corrective actions, and we will discuss that. Having said that, we do not think that the concept of variable annuities with guarantees is a bad concept. These products have been extremely profitable over the last 13 and a half years. There has been half a year of very bad performance for the hedging. It's an extreme stress test for the model. We think we can correct it, and we are not going to see 13 years of bad experience going forward. Second point, fall in equity markets. This is impacting us. Will continue to impact us because, as you know, we are living from commissions extracted from asset bases. This has been a negative element, and we've also been affected by the lower level of unrealized capital gains in shareholders' equity. Third point, the very strong widening of the credit spreads. As I said, this has been impacting the net income. In front of that, do we have some good achievements? I think we are not going to apologize for some of the good achievements. We've had some. The first one, which is important, is we still have a growing number of clients. The revenues have been quite resilient. Yes, the new business is more difficult in life and in asset management, but the business is growing in property casualty, growing sometimes strongly, and even in life and asset management, the preservation of the market shares has been quite significant. Second point, as I said, underlying earnings have been solid. Third point, the balance sheet is strong. I know this is something which is a source of concern for you, but it's precisely in these times that balance sheets are, I would say, stressed, put under pressure. We have a Solvency I ratio of 127. We have a Solvency II ratio of 145. A solvency is a sort of driving license with points. To avoid any questions from the regulators, you need to be at 100. We are at 127. We have 27 points of, I would say, over capacity on our driving license. It's less than what we used to have. I do not think we are in a sort of fragile situation. What we need to do is to manage it very carefully, because it's certainly not the comfort margin we used to have. We need to be prepared if the macroeconomic environment gets worse, and we will discuss what we are doing to add some tools to the toolkit we have. But I don't think this should frighten neither us nor you. Last but not least, we are paying a dividend. It's a conservative one. It's 40 cents. It's 1/3 of what it was last year. We want to show the sign that we have confidence in the future. On the other hand, as I said just before, we think we have to be cautious in the capital management. Revenues, very clearly, what do they show? Life and savings, they are going down by approximately 4%. This is mainly due to what we've seen in the US, but also in some other countries. You know that the clients are scared. They don't want to do long-term investments in the current environment. And for a long period of 2008, now it's less the case. It was not very expensive for them not to make any choice, because short-term deposits were decently remunerated, certainly in Europe, maybe less in the US. Now, things are probably slightly changing, so more difficult to make long-term investment decisions, which explains probably part of the thing. Second point, property casualty. Property casualty is doing well. I do not insist on that. Denis will come back to that. Asset management, the decline in revenues is due to the fact that asset bases are lower. This is impacting the fees. It's a very mechanical effect. There is going to be there too, one day or the other, a turnaround. Nobody at this stage knows when, but we think that the franchises we have are still very solid and very strong franchises. If you look at the geographical diversification of the group, and this is an important point, it's true as well in earnings as in revenues. The diversified model we have is helping us resist better than others. Yes, we've had a very tough year in the US, but other than that, I would say the operations have performed decently or sometimes well. If you look at what it gives, there has been a decline in the US in revenues. Continental Europe has been stable. The emerging countries and the Mediterranean region have done quite well. Underlying earnings, I think I've already mentioned the key elements. If you look at the detail of the underlying earnings, the big negative factor this year is the fact that the US have moved from a situation where they were contributing for something which was between 800 and €1 billion a year to the group earnings. This year it's negative by around €200 million, so it's a big swing due to the cost of hedging. On the other hand, this has been mitigated by some very good performances, especially in France and in the Mediterranean region, where we've seen a very good property casualty growth, but also a very good property casualty earnings and very decent life and savings earnings. There too, I really insist on that. The geographical diversification of the group is good from a risk management standpoint, from an earnings standpoint. If you look at the adjusted earnings, so underlying earnings plus or minus capital gains realized and impairments, it's a decline when compared with last year. Last year we had realized 1.2 billion approximately of capital gains. This year it's a loss of a little more of 340 million. Why so? We have realized some gains, but we've had the cost of the impairments mitigated by the hedging of the equity portfolio. And Denis will come back to that in more details. Last but not least, the net income. Net income is down, as I said, around 80% at 923 million. Why so much? What went wrong? If you look at the economic view, moving from the adjusted earnings, we think there are additional hits which have been taken, which can be justified from an economic standpoint for approximately 900 million on ABS, on some of the alternative assets. Other than that, what we see because of the IFRS is a 1.5 billion reserve on the change in the fair value due to the corporate spreads. And we think this is going to be largely an accounting issue only. And remember, we do not have the reclassification possibilities the banks have. So it's impacting the net income. Two other elements, change in fair value of balance sheet hedging items and change in fair value of other assets and derivatives. Denis will come back to that also, because these are elements which are very mechanical, sometimes have their counterpart in the other direction on the balance sheet, and we see them as non-economic. So if you were to adjust the net income for what we see as being these non-economic factors, the net income would have been at 2.8 billion, which is, of course, way lower than last year, but not in the same proportions. Dividend, I've discussed that. It's less than the usual guidance we had been giving between 40 and 50% of the adjusted earnings. But we think at this stage, in a very, I would say, uncertain world, it's prudent balance sheet management. Solvency ratio, 127 Solvency 1, as I said, 145 Solvency 2. We'll come back to that. It means that we have a 6 billion euros surplus at this stage. Remember also that the underlying profitability of the group is rebuilding the solvency. And remember that a significant portion of the decline in 2008 was also due to the fact that we have paid for some of the very recent acquisitions. So they are buffered there, and we are adding additional flexibility with some capital management initiatives, which we will describe later. Next point. Liquidity position. Well, I mean, the cash flows over all the businesses have stayed very solid. In the life business, if we have seen less new business, we've also seen less redemptions. And the net cash flows have been positive by more than 8 billion. And the cash flows have been positive by around 3 billion on the property casualty side. So the cash flow position of the group is strong. If you look at the balance sheet, and Denis will describe that, the cash position has increased massively over last year. If you look at the debt, we have a significant amount of undrawn credit lines. We do not have significant debt maturities in 2009. So overall, if you look at it, we think it's a very safe position. Last but not least, because even if everybody these days is focused on the balance sheet, nobody should miss the point that the businesses we are going to survive are the businesses who are going to keep their clients and their employees and keep them happy. If we look at the measures we use every year, one of the signs of confidence, I think, is the fact that looking at customer satisfaction and looking at employee engagement, both of them have very significantly increased in 2008, despite all this negative turmoil, which means that the sales forces, the employees, they are dedicated at winning business, at growing the company, at resisting to the storm and spending time with the clients to help them understand what's going on. So at the end of the day, even if these are difficult times, and even if we do not pretend to be immune, we think that we are well positioned to make the difference in the long run. Denis, it's yours.
Thank you, Henri. Good morning. Good afternoon, sorry, everyone. So I don't think I need to go for a long time on a summary because on earnings, Henri has said everything. Balance sheet, our shareholders' equity stands at 37 billion euros at year-end, impacted essentially by a 5 billion decrease in unrealized capital gains, mainly on equities. We believe that we continue to have sound debt gearing and additional financing capacities. Going back to the earnings and starting with the underlying earnings, our underlying earnings were down 17% on a comparable basis, and this is made of 43% negative on life and savings, 31% positive on P&C, 6% positive on asset management. I will come back to that later. This is essentially due to a tax one-off, otherwise it would have been slightly negative. 21% negative on international insurance because of the runoffs, and substantially negative on holdings because of additional financing costs. On the life and savings underlying earnings, we've slightly modified the presentation that we were doing before, but we are still looking at gross margins on one hand and expenses on the other hand. So we've split the margins between margin on revenues, margin on assets, and technical margin. You see that margins on revenues was plus 3%, margin on assets down 6%, and the big swing has been coming from the technical margin, which went from 1.4 billion positive to 51 million negative, and I will come back to that. Expenses were roughly flat. Acquisition expenses slightly down as new business was down. Admin expenses slightly up as the cash flows were up and we were managing more contracts. VBI amortization slightly up as well, leading to a pre-tax underlying earnings of minus 50%. Tax with still positive one-offs of tax down 70%, minority interest another 31, leading to 43% negative on the underlying earnings. And I will now describe in more detail the various components. Margin on revenues was made of an average margin on our revenues of 7.4%, up 7%, with revenues down 4%, so the margin on revenues is up 3%. On the assets, starting with the unit-linked management fees, those fees were down 10%, as our average unit-linked reserves were down 8%, and our average management fees were slightly down 3%, 2% coming from business mix, 1% from country mix. The variations around this figure are quite small year on year. What you can see on the unit-linked reserves is that the average reserves are only down 8%, but we are starting the year 2009 with reserves that are significantly down at 132 billion versus 883 at the beginning of the year. We have a negative impact of the markets of 49 billion, 8 billion net inflows and 11 billion negative on Forex. So margin on assets is slightly down 6. General account investment margin is stable, as our reserves on general account are stable, plus 1% at 318 billion on average, 323 closing reserves against 309 opening reserves. This is positive FX and positive market impact. No net inflows. All our net inflows have continued to be on the separate account or unit-linked side. Average management fees on general account have been stable. Now moving to the technical margin, the mortality morbidity margin has been relatively stable. It's down 12%. What's effectively hitting us on the technical margin, as we said, it's the exceptionally high cost of hedging the variable annuity guarantees. We've discussed that extensively during our November meeting. We were hit by basis risk, i.e. the difference between the performance of our funds and the performance and the hedges that we have used against the indices for 655 million euros. Volatility, which was exceptionally high in the fourth quarter of 2008, costing us 596 billion, and other factors for 72 million euros. So this 1.3 billion euros gross impact is consistent with the 0.6 billion net P&L impact that we had described in our November meeting and call. Moving now to P&C, again using the same breakdown between net technical results and net investment income. We had revenues up 2.9% at 26 billion euros, a combined ratio improving by 1.9 points, and obviously there is a big leverage coming here because the net technical results out of this multiplication is an improvement of 97% at 1.1 billion euros. On the investment income side, our average assets were up 4% at 54 billion euros. Our average asset yield was up 8% at 4.2%, leading to a net investment income of 2.2 billion euros or plus 13%. This leads to pre-tax underlying earnings growing by 32% at 3.4 billion. Tax is roughly proportional, and we have underlying earnings up 31% at 2.4 billion euros. You can see that we have a good story here, both on revenues and combined ratios across the board. Slower revenue growth in Northern Europe, higher revenue growth in France, Mediterranean region, and the rest of the world. I should have said slow revenue growth in Northern Europe, UK and Ireland. Combined ratio, a good story across the board with the exception of Belgium and the rest of the world, but still a good story everywhere with no combined ratio above 99%. Extremely strong combined ratio in France at 93% and Mediterranean region at 93.3%. But good combined ratio overall. How did we achieve that combined ratio? It's a combination of the non-recurrence of the natural events that we had suffered from in 2007, the floods in the UK, the storms in Northern Europe, which giving us an improvement of 1.7 points. We have a slight deterioration of the current accident year of 1.3 points. And better prior reserves developments, giving us an improvement of 2.2 points. Or positive, I should say here, positive reserve developments giving us 2.2 points, and slightly better than last year. The expense ratio is slightly deteriorating, but I would say that almost the totality of that deterioration, or 0.4 out of the 0.5, is due to a one-timer in Germany an exceptional adjustment of pension expenses. So I should say that all in all, our expense ratio is broadly flat. Looking more in detail at the what's happened on the reserves, when you look since 2000, our reserving ratio, meaning net technical reserves divided by net earned premium, has fluctuated between 186 and 196%. And there are many reasons for those variations, which are the scope of the business, the country mix, exceptional events in terms of natural events, and the variation of prior reserve developments. When you look at the decline of 7 points for AXA in 2008, there is a scope change of 1 point, meaning that we are adding countries which have faster reserve developments. There is a country mix impact of 1 point, meaning that countries which have a faster reserve development are growing faster than countries that have bigger reserves. We have a non-recurrence of Nat Cat, which is 2 points, and we have increasing prior reserve developments that represent 2 points. And you see here the development over the last 10 years. You see that we had one negative year in 2000 for 0.3%, and you see that we have more strongly positive developments in the last 2 years, which I believe is consistent with the point in the cycle where we are. We believe that we were in 2008 at the bottom of the cycle in Europe, which is the bulk of our business, and it's not a surprise that we have better prior year reserve development as we approach the trough of the cycle. Moving now to asset management. We have benefited from, as I said before, from non-recurring items. Without those non-recurring items, our asset management revenues were down 11%, distribution revenues down 32%, investment results is a small number. On the expense side, asset management expenses were down 10%, almost in line with revenues, and distribution expenses were down 23%, slightly less than distribution revenues. Our pre-tax underlying earnings were down 15%, and tax was down a lot more because we had a 62 million euro one-off in the US. So underlying earnings on a comparable currency are up 6%, but this is entirely related to this tax item. Going into more detail, the asset management revenues are a function of the lower assets and average assets under management, down 8%. But you see that the decline has been sharper between the beginning of the year and the end of the year, essentially due to market impact of minus 245 billion euros. So this will clearly have a knock-on impact on our 2009 asset management earnings. The asset management fees have declined by 3%, 36 basis points. This is entirely a function of the reduction of the weight of equities, because the asset class that has declined the most is obviously the equity asset class. The equities only represent 39% of the total instead of 53% a year earlier. Moving now to the adjusted earnings. We're starting from the 4 billion of underlying earnings. And as Henri explained earlier, we had half as much realized capital gains. We realized most of our capital gains in the first half of the year, 792 million. We had a very significant impairment of close to 2.8 billion euros, essentially equities, 1.8 billion, but also 500 million euros of fixed income. This was partly mitigated by the equity hedging for 1.6 billion, 1.3 coming from the equity hedging, what we call the global macro hedging done at the group level on 14 billion euros, 300 million coming from the hedges done locally, essentially in France and Germany in the life companies. The hedging didn't fully mitigate the equity impairments because of tax effects. We have some equity impairments that do not give rise to a tax credit. That's the case, for example, in Belgium, where equity capital gains are not taxed, equity capital losses are not deductible either. So that's what explains the 3.7 billion earnings. The two other things I want to mention here are that we put here the totality of the value of the equity hedges, whereas at the half year we had put the time value in net income. Here, because we crystallized all the, we reversed the hedges basically in January 2009 for the most part. We decided that it was more relevant to put the time value in adjusted and not put the time value in net income. The second comment I want to make is our impairment rules. On equities, we have quite mechanical impairment rules. Any stock that is down for more than 6 months or down more than 20% is impaired. I believe that this is one of the most stringent rules that is applied in Europe. On fixed income, we impair on credit events and only on credit events. Now moving to the net income, starting from the adjusted earnings of 3.7 billion euros. We suffered from a change in fair value of a number of positions on our balance sheet. 1.5 billion is coming from the increasing spreads on the corporate bond portfolio. A substantial portion of our corporate bond portfolio is in AFS P&L, available for sale through the P&L, the so-called fair value option. So it's a mark-to-market that we have to do. We had also mark-to-market on alternative and equities for 447 million euros, on asset-based securities of 412 million euros, and other balance sheet items, 222 million and 144. So this is a substantial portion of that is non-economic. Henri has described that earlier, but we have to take those mark-to-market hits even if they are not economic. We usually show you, and we are doing it once again, our cash flow, shareholder cash flow statement, starting from the adjusted earnings of last year of 6.1 billion. We adjust by 2 billion to reflect the difference between the adjusted earnings and the statutory results of last year. We have an increase in in consolidated solvency requirements of 1.3 billion. We have capital optimization for 600 million. That gives us the cash flows from our operating companies available for investment and dividend of 3.5 billion. We paid a dividend in 2008 of 2.5 billion, and we made acquisitions for a net of 3.3 billion, the biggest ones being Russia, Mexico, and the buyout of our minorities in Turkey. So that represents a need of financing of 5.7 billion euros, so higher than 3.5. And we've had capital increases with our employee share plan, essentially, and a few exercise of stock options for 500 million euros, and an increase in our net debt of 1.7 billion to offset the difference between the 3.5 and the 5.7. Moving to the shareholders' equity, the shareholders' equity moved from 45.6 billion to 37.4. It was positively impacted by net income of 923, the dividend of last year of 2.4 billion, share plan and stock option for 700 million. We had a negative variance, and this is the biggest item, of 5 billion euros of our unrealized capital gains, which I will comment further. And then other negative impacts, Forex for 1 billion, our pension, an increase in our pension gap. We used the SORI option for 700 million euros, and a decrease in our perpetual debt coming from both FX and the payment of interest. So that leads to the 37.4. Commenting on capital gains, we have two movements in capital gains. The off-balance sheet capital gains on the left-hand side on real estate that have moved from 2.1 billion to 3.4 billion. There is a little bit of scope change, and there are two other changes which are more important, which are related to the reduction in the tax rate and the reduction in the policyholder participation assumption. I believe those are the two main changes. On the unrealized capital gains, we've moved from 4.8 billion positive to 0.4 negative. We still have 500 million euros of unrealized capital gains on equities. This is clearly a big number. On the other hand, we end the year without a big item of unrealized capital gains. On the total balance sheet of AXA, which is 670 billion euros, we have 0.4 billion of unrealized capital loss, which is quite a small number compared to a number of insurance companies around the world. Our net debt has moved from 15.8 to 17.7 billion euros. I already mentioned that to finance the acquisitions that we did in 2008. There was no significant movement in the subordinated debt. There was a slight increase in the senior debt, which moved from 2.3 to 4.2 billion. You can notice that we have no significant maturity coming up until 2013. So we are quite safe from that standpoint. We still have 6 billion of undrawn credit lines, and on the consolidated balance sheet, we have 32 billion euros of cash. Looking at the general account portfolio and the quality of assets there, the total general account has not moved much, moving from 394 billion euros to 390. Fixed income is relatively flat, representing 77% and 300 billion euros. In the fixed income, it's about half and half govies and corporate bonds. We have 11 billion of asset-backed securities, representing 3% of the assets, which have been marked down from 89% of par to 69% of par at year-end. Of those 11 billion, at year-end, 7.5 billion have been marked down using mark-to-model and mark-to-market for lack of credible market information. If we compare this mark-to-model and the mark-to-market, the difference is 2.1 billion gross, which would have been translated on a net basis into 700 million of OCI impact, so balance sheet impact, and 200 million of P&L impact. But we truly believe that the mark-to-model is more realistic than the mark-to-market for those assets where the very scant trades that we can find are not really credible. On the cash side, the cash moved significantly up from 19 to 32 billion euros, coming both from prudent liquidity management at a time of unprecedented market turmoil, but also from the cash held in relation to our derivatives program, where we are getting, as markets came down, the derivatives that we had on the balance sheet gave us a lot of cash that we keep on cash on our balance sheet. Our equity portfolio moved from 37 to 17 billion euros, representing 4% of our portfolio, and the rest didn't move much. I will come back to the equity portfolio slightly later. I'd like to go through the risk review, what we call the radar screen at half year, to update you on the, I hope, the various concerns that you've expressed during the last 6 months. want to cover actions taken to mitigate the balance sheet risk in terms of asset liabilities and ALM, and address any question that we have heard from the investor community in the last 6 months. So we are going to update you on equity hedging, DAC, VA risk management, solvency capital, double leverage, low interest rates, and financial hybrids. First, the equity portfolio. We had an equity portfolio at year-end 2008 of 16 billion. We have kept 4 billion of local equity hedges in the life companies, in the participating life companies. There is this translated to a net 7 billion of outstanding equity exposure for the shareholders. We have not re-established the global macro hedging program at the group because we believe that the outstanding exposure is small and the price of hedging has become uneconomic, and we don't believe that we need to pay that insurance policy. And as I said, we've monetized the majority, almost 80% of the hedges of the macro hedging program. We have now a fairly low sensitivity to equity market movements up or down, and which is described at the bottom, the top right of the slide, and we may come back to that in the Q&A session. On DAC, we have taken significant DAC impairments in 2008 for a total of 569 million euros before tax, resetting the corridor with a central assumption of 9% separate account return going forward, which means that we would need a 30% market decline to have another DAC impairment going forward in the US, allowing for the normal return to the mean assumptions that the group has been using since, for the last decade. Clearly, the big hit in 2008 has been US VA hedging. We had said at the half year that we were putting in place an action plan to mitigate this, and we have completed, I would say, phase 1 of this plan. On a new business side, we've launched Accumulator 8.0 in November 2008, Accumulator 8.2 in February 2009, both reducing some of the features of the program and also narrowing the options in terms of investments for the funds. But the bulk of the impact, the more important impact that we have had, has been on the in-force, which is obviously the most impactful from an earnings standpoint, where we have completely changed the structure of the separate account assets by restructuring the allocation funds, reallocating assets to index plus or index-like funds. So this is clearly a major. This was clearly a major exercise which required the approval of the fund boards for a significant part of what took place. But this is now behind us. This plan was implemented, it started to have impact at the end of October, but was not fully in place. It's now fully in place for 2/3 of the separate account assets. We have a phase 2 in 2009, which is the launch of a new version of Accumulator 9.0 in July 2009, where we will again revise the features to improve the profitability. And we will continue to adjust the separate account funds so that we continue to reduce the basis risk for the remaining volatile separate account funds. This action plan has started to bear fruit. We don't give you the breakdown of the results, but we can tell you that the results of hedging were positive in January, and this is quite comforting because January was not a year of normal volatility, a month of normal volatility, neither was it a month of positive markets. It was a month where markets have come down probably 9 or 10%, and it was quite reassuring to see that the plan was indeed effective. Solvency now is clearly a big concern for you. Solvency I ratio comes out at 127%. Solvency II, using the same parameters as the QIS4, the Quantitative Impact Study number 4 of the European Commission, puts us above 145%. I remind you that we were at 170% at year-end 2007, 175 at the mid-year. We end the year at 145, which shows again the resilience of Solvency II, which is more economic than Solvency I. Where do we go from here? You can see two things. First, at the current level of underlying earnings of 4 billion euros, we would build 18 points of solvency before paying the dividend. The other side of the coin is that when we look at sensitivities, we still have sensitivities to market movements on our balance sheet. A decline of 10% of the equity market represents 3 points. An increase in defaults on fixed income, 3 points. A decline of real estate by 10% represents 6 points. And private equity, 2 points. We believe that we are at a comfortable level and that we don't need to raise equity. But we decided to take advantage of a new provision of the French law, which has allowed us since November of 2008 to create preference shares. And in the same way as we have in our list of resolutions to be approved by the shareholder meeting, resolutions regarding issuance of equity and other instruments, we are adding resolutions that would allow us to issue preference shares if necessary. We have 4 resolutions in our list of resolutions, one which modifies the statutes and describes what the preference shares are, and 3 that allow us to issue preference shares to the AXA mutuals, to our existing shareholders, or to investors without preferential rights. And we believe that we have with this a full arsenal. The total amount that we would be able to issue is 2 billion euros, and we are aware that the AXA mutuals would have the capacity, if required, to subscribe to preference shares because they happen to have the cash available to issue buy up to 2 billion euros. How do preference shares work? First, they are senior to the capital, to ordinary shares, and they are subordinated to all debt. They give rise to a dividend which has been calibrated in these resolutions between 1.2 times and 1.8 times the dividend, with a floor of 6 to 8% and a cap of 10 to 14%. Those brackets are quite broad, but that would give the management board the flexibility to define the conditions at issue, depending on market conditions at the time. These preference shares are redeemable at par. They are not redeemable before 5 years, and to be redeemed, we need to get the approval of the insurance supervisor, and we would need to be above 100% of solvency margin after redemption. The dilution of preference shares obviously is roughly 3 times less than the dilution of ordinary shares, and this is just an additional weapon to our arsenal. The next topic is related to so-called double leverage. We thought it was useful to go into some detail on that because there is a lot of confusion around. First, let me remind you that AXA is an insurance group, not a financial conglomerate. The small quantity of capital that we have in banks, asset management, and brokerage is deducted from the Solvency I calculation, and under Solvency I, we get no diversification benefits. So when you look at it from a statutory standpoint, which is the left side of the slide, we have imagined a holding company with a capital of 200 and debt of 100. This holding company is supposed to have 3 subsidiaries with capital of 100, so that means that the debt at the holding company level has been used to create capital in the subsidiaries. There may be, depending on the local regulations, there may be intra-group loans which are limited by the local solvency rules, which vary by territory. So at the holding company, we've not defined what the solvency was, but at the local entity level, the local solvency can be 200% if the requirement is 50 and the capital is 100. So in this statutory view, clearly double leverage is not captured. At the consolidated level, it's different. The solvency ratio is defined as the admissible assets minus the debt divided by the capital requirements. The intra-group loans are eliminated, and when the Solvency I ratio is, say, 133%, that means that the addition of the solvency requirements of the 3 subsidiaries of 300 is reduced by the debt of 100, and the solvency denominator is 300 minus the debt, so it's 200, and the requirements at 150, so you get to 133% of Solvency I ratio. So there are no diversification benefits. Intra-group loans have been eliminated, and the debt has been deducted. So in the Solvency I ratio, the double leverage has been fully captured. Another concern is the impact of low interest rates on the life and savings business. We are protecting our earnings and our investment margin. Our guaranteed rates have declined steadily since we are publishing that information. In 2004, when we gave our asset liability management presentation, we showed an average guaranteed rate on our portfolio of 3%. It's now 2.6% because we are issuing less products with guaranteed rates, and 2.1% in 2012. We have a 7-year duration of assets, which is mitigating the drop in interest rates. And right now, the corporate bond spreads are offsetting the declining interest rates because basically the spreads are offsetting the difference between the risk-free rate as it was a year ago and the risk-free rate where it is now. Finally, exposure to financial hybrid debt. In a nutshell, we have a substantial portion of our debt, of our corporate debt, which is with financials, 55%. This is just a reflection that the bond universe is such in the AA and single A category that there are lots of financials. Of that, we have, for the shareholder part, 600 million euros of exposure to Tier 1 hybrid debt of financial issuers. So a very small portion of our corporate bond exposure. I believe this ends my presentation. I thank you for your attention. I give back the floor to Henri. Thank you.
Thank you, Denis. I'm not going to be long because I'm sure that there are going to be a lot of questions, but I just want to make a short conclusion. As you've seen, we are not pretending that we are immune to what has happened out there. Yes, we are affected in the life and savings business. Yes, the solvency margin has been reduced by the market impact. Having said that, The group is resilient, as showed by the underlying earnings, and the group is still strongly capitalized. And having been in this business for 20 years now, I'd like to make one thing extremely clear. It's not the first crisis. Maybe it's the most severe, but the ones who are going to emerge as winners in this crisis are the ones who are going to keep their nerves. It's true as well for the management as for the investors. What we see as our duty as a management team is to be fully transparent with you and to give you all the information we have, what we've been doing this afternoon. The second thing we need to do is to tell you how we feel and where we stand. What we are telling you is, yes, it's difficult. We've seen better and more enjoyable times, but we think these are also the times where we can make the difference. We are solid in our balance sheet, and we are very determined to continue to do what we've done over the last, say, 30 years with AXA, and over the last 10 years since I took over as a CEO. This group is convincing more clients every morning. The margins in the business long-term are good. There is nothing changed to the fundamental needs of the clients. And at the end of the crisis, we are going to have probably less competition than before. So the key point is, how do you navigate through the storm? It's difficult to navigate through the storm, especially when you have slightly less resources. But you can navigate through the storm. And we will navigate through the storm. That's it, and let's go for the questions. Sorry, embedded value, Gerald. Yeah, because this is another thing we want to cover, because we know you have questions there. So, Gerald.
Yeah. Yes, in fact, there are a lot of questions relative to embedded value. And so, okay, let's start by this one. So I know that you have been troubled by this restatement. And in fact, this restatement is simple. So that means that we have replaced, in order to be compliant with the CFO Forum guidelines, we have been replacing the other than life tangible net asset value by the shareholders' equity. So what does it make concretely? And you have the restatement here. That means that instead of group EV of 34.8 billion, we end up with a group EV in 07, that's a restatement for 07, at 50.6. So that means that we increase by 15.8 billion the last year EV. For the sake of clarity and transparency, I'll give you information on the following slides as if this restatement would not have been done. So next one. Here you have the roll forward of the group EV. So group EV starts at 50.6 billion, ends up at 31.1 billion. That's the new CFO Forum-like EV. So that means that we have a decrease of 19.5 billion. We have an operating return, and I have a slide to explain how it behaved, but the operating return is in line with expectations. We have an investment experience of minus 22.08. So that's the main element that explains this drop of 19.5. In case we would have been in line with last year's presentation, we would move from 34.8, which was last year group EV, to 18.6 billion. So that means that it would have been a decrease of 16.2. 16.2 decrease compared with the 19.5 that we are presenting here. The difference corresponds roughly to the mark-to-market of debt, since debts now and the super-subordinated debt are part of the shareholders' equity, because we replaced again for other than life business, the tangible net asset value by the IFRS shareholders' equity. Let's move to the operating return. So, two elements there. Let's start first with the life and saving operating return. Expected return, 2.7 billion, corresponding to 5% of group EV. That's in line with last year implied discount rate, roughly slightly below 8%. Operational experience is 0, so it's 0%, it's negligible. And then we have the NBV. As you can notice, the NBV is down this year from 1.8 billion to almost 1 billion, and this represents a contribution to the group EV return of 2% instead of 4%. Then for other business operating return, we have a 2.7 billion contribution corresponding to 5%. What does it correspond to? Mainly to the underlying earnings, which are at 2.5 billion, minus the interest rates on super-subordinated notes, roughly 300 billion, and a normalized equity capital return at 4.5, capital gain return at 4.5%, corresponding to 400 million. So, and that's exactly the same way as what we did last time. So as a whole, operating return 12%. Let's move to the investment experience. So on the second line, you have a 12% operating return, and as a whole, total return on group EV is minus 31%, explained mostly by this negative investment experience at minus 44%. And here, at the bottom of the slide, you have the explanation in billion euro of this 22 billion decline and negative contribution of investment experience, starting first with impact from equity market drop, minus 12 billion. That's, we are no more in capital gains, as you noticed, and we have lower fees expected on unit-linked. Impact from spread widening, this has been explained already by Denis. We have a minus 7 billion contribution, corporate bond spread widening. Just to keep you, it's important for you to keep in mind that on our corporate bond portfolio, we started the year with an average spread of 140 basis points, and we ended the year at 350 bips. So that explains the minus 7. So that means that everything equal for next year, assuming for 09, assuming that we would be in line with the expected return, that means that our return would be 20%, i.e. 6.2 billion divided by 31 billion, which is the group EV. Going back to the old methodology, then the return would be exactly the same, 6.2, but divided by an EV that would be lower, i.e. 18.6 billion, as I told you before, and ending up with a return of 34%. Last, let's have a focus on the new business value. So new business value last year amounted to 1,772 million euros, and at the end of 08, for 08, we are at 985. So that's a drop of 44%, and you have all the different elements. First of all, let's start with the APE. Annual premium equivalent dropped by 10%, explaining a 10% drop. Then another important element is the expense. Expense contributes to minus 7% to this 45% drop. Why? Because, as you know, in line with the methodology, we are not allowed to take into account any kind of productivity gains. At the same time, market conditions, minus 30%. Explains that the last line, explained as an NBV margin. NBV margin moved down from 23% to 14.5%. Mostly explained by the market condition at minus 7.3%. What is interesting is to have a look at the bottom figures here. Because you can notice that what are the most important elements that explain this minus 7.3% decrease in the NBV margin. The most important one is higher volatilities, 3.5%. Then we have the lower interest rates at 1.9, mostly with a hit on the VAs business. Then we have equity markets minus 1.2 and spread widening minus 1. Concretely, what does it mean? That means that assuming that the volatility would go back to previous level and that the spread widening would go back to previous levels, that explains 4.5%. 4.5% compared with the 14.5% NBV margin at the end of the period, that's back to 19%. And I believe that's something that we should keep in mind. Thank you.
Thank you very much. We'll go for question now. Yeah, Blair.
Thanks very much. Blair Stewart, Merrill Lynch. I'll limit it to two questions. The first one is, could you talk a little bit about the available capital you have under Solvency I? I think it's 28 billion, just to get an idea of the quality of that capital and what the risks to that number would be in future. So ideally a breakdown of how that capital sits. And the second question is the impact on earnings from spread widening. I think most of the impact goes through earnings, 1.5 billion. It looks quite a small number relative to the size of your book. And Gérald's comments of a 200 basis points spread widening over the year. I think you've got a book shareholders participation of about 60 billion roughly. So 1.5 over 60 doesn't look a high number.
Who wants to take that? Denis?
On the spread widening, Gérald, do you want to take the question?
Yes, on the spread widening, the cost of the spread widening, as you noticed, was quite important in the P&L account, in the net income, roughly 1.5 billion. That's what Denis explained. But this has also a significant impact on the shareholders' equity in OCI. Why? Because, of course, when you look at the OCI, you are close to zero in terms of unrealized capital gains on bonds, but you have a large positive effects on the T-bond and a negative effect on the corporate bonds. Roughly speaking, but it's a very rough figures. Roughly speaking, we could say that it should be something around 5 billion. So plus 5, minus 5, something of this magnitude.
I think, Gérald, Blair was also willing to know if the 1.5 in the net income had been mitigated by any policyholders' participation, if I understood you. No, that's fine. I mean, you have your... Okay. On the second point, which is the available capital under Solvency I, who wants to take that?
Well, on the available capital under Solvency I, which is 28 billion euros, I think the requirement is 22, the available capital is 28. We have written off all intangibles, so it's high quality capital. I don't know what more to say than that. I mean, there is no intangible asset included in that capital other than a small portion of the value of business in force for France and I believe Belgium. So that's the only intangible that there is, which is still available for 2008 and 2009, according to the EU regulation.
Maybe what we could add, Denis, is that there is no magic in these figures. So that means that when comparing the evolution of available capital for Solvency I between 07 and 08, we moved from 31 to 28 billion. So that means that it's a drop of 3 billion. And so we have the positive contribution from the earnings, from the net income at 0.1. And we have also the decrease of OCI. OCI dropped by roughly 5 billion. So that's the main element. There are other elements, but you can explain by this a 4 billion drop, and then you have other remaining moves.
Next question. Yeah. Well, whoever. Who has the mic?
Mark Thiele from UBS. First question on if I add the 2 billion of preferred capital, that's roughly 9 percentage points of solvency. So the 127, I arrive at 136, let's say. That's still a low number against your international peers. And I wonder if you just rely on stable markets from here, retained earnings coming through to get back into the old corridor that we used to have of 150 to 170 as the target. The second question is on the cost side. Do you feel there is more need to cut into the cost base other than the 200 million of the program that I think is going on in life insurance, given that there's considerable pressure on the revenues? And then thirdly and finally, I miss your slide on M&A that you presented in November. Is that something we should write off altogether?
Okay. Good questions. First, well, I mean, I don't think 9 points are, quote, negligible. Second point, we don't think we need to do it now. As I said, what we are saying is we want to add a tool to the toolkit. First point. Second point, I think you should take some distance with only the pure solvency margins, because you have to look also at, is the capital really available? And as Denis and Gerald have pointed out, the capital in our case is really available, which is, I think, an important factor. Second point, I think you have, and there too, I mean, it's a pure question of common sense. Who is asking you to have regulatory capital? The regulators. Our job is not, and sorry for saying that, but our key job to preserve the wealth of the shareholders is not to make the journalists or the analysts more comfortable by diluting the shareholders unnecessarily. Our job is to fight for the preservation of the wealth of the shareholders. And therefore, the way we have to look at the solvency is to see if the regulators are asking us for more capital at a certain point in time. And that's what's going to drive us, nothing else. Okay? Do you want to add something there?
2 points. One, insurance is not banking. So there is apparently a flight in banking to get to a high Tier 1 capital ratio. In insurance, I mean, clearly this is not the topic. We don't have, I mean, we are not key participants in the financing of credit to the economy, or not to certainly not of new credits to the economy. Secondly, we have prudent reserves, and the reason for capital in insurance is to offset a deficiency in reserves, and we have no deficiency in reserves. I mean, we are showing year after year that our P&C reserves are quite conservative. So capital is on top of that. Our supervisor doesn't ask us to have more than 100%. It happens that we have a cushion above 100%, but we are not forced to have a higher cushion. And last point, I'd like to guard you again against international comparisons on Solvency I ratios, because the calculation of Solvency I ratios across the EU, unfortunately, is quite diverse. The rules are very different, applied in a different fashion, and that's one of the reasons why we've been very much in favor of Solvency II, because it was both economic and we expected to have the same rules applied everywhere in the same way. That's absolutely not the case in Solvency I.
And if you use Solvency II, even if Solvency II has not been approved, I mean, the excess level vis-à-vis the minimum regulatory levels is quite large. So, next point on the cost side. You are referring to 200 million. In fact, I mean, what we are doing is going to be more. Yes, we are starting. We are not starting. Yes, we've been addressing the productivity issues. It's clear, as an example, that in the asset management, there are actions going on, because both at AllianceBernstein and at AXA IM, the decline in the asset bases is compressing the margins, and they need to react to preserve their earnings capability. It's clear that on the life side we are doing things. It's clear also that on the property casualty side we remain with I would say quite significant margins for productivity. We still have a claims management improvement program on the property casualty side, which we expect is going to give us approximately 700 million euros between now and 2012. So it's a constant exercise for us to try to find productivity in the operations. And I would say the environment is, if anything, forcing us to accelerate that. On M&A, I liked your question. Let's be totally clear about it. The first thing we want to do is to manage through the storm, okay? And this should be the priority number one for the management. Having said that, we know we are a consolidator in this business. If there are absolutely unique opportunities available, if these opportunities are accretive to the shareholders through a proper financing, we should not refuse to look at them. But it's exactly like two ships in a very difficult sea. If you want to bring them together, maybe you have to wait a little bit to see the sea being a little bit more calm. Okay? But I don't think it's something we should, I would say, drop like a shoe, because once more, the companies who are going to be winners in this turmoil are the ones who are going to keep their nerves and preserve their margins to be in a position to be the first to react the day where there is going to be some blue sky. Okay?
Nick Holmes at Nomura. First question is, if the macro environment really does tank further and the rating agencies start to look to a downgrade to a single A, not because of anything you're doing, but because of the macro environment, and obviously you're clearly double A at the moment, how would you respond to that? I mean, does it worry you being, say, a straight single A? Then the second question is the off-balance sheet items rose in value a lot to 3.4 billion. Wondered if you could just go through what is happening there, and sort of related to that, on real estate, I wondered, I was interested in the sensitivity that you showed for real estate for solvency, and I just wondered if you could elaborate a little bit more on where this real estate is, what sort of geographies, and what you think of it as a potential threat. Thank you.
Thank you, Nick, for these questions. On the first one, on the rating agencies, as you all know, I mean, it's a relative game, or it's a relative position which is important. If the world tanks further, being a single A company is going to be being in a still very strong position. So what would worry me in such a case is not our own situation. It would be the world situation. But I think there too, I mean, you have to step back and look calmly at things. How many corporates are double A? Very few. How many corporates are single A? Few of them. Insurance companies, because of the strength of the balance sheet in the previous decade, have had strong ratings. Some of these ratings have improved, by the way, over the last years. It's not that long ago that we were a double A minus company, in times which economically were better than today. So the whole thing is, how do you stand on a relative basis when compared to peers? And does this prevent you from doing some profitable business? If the world tanks and if everybody is single A, I don't think it's a real issue for one of the players. The other point is, all things equal, today, if you are not a double A, what sort of business are you losing? The business you would be losing today, not tomorrow. I mean, if everybody is single A, the business will have to find a place to go. But today, the only point where the rating would have an impact is the US group business, which is not the most important and is not the most profitable. So I think we should look at it in a relaxed way. Not that we should not be concerned by the view, I mean, interested and take seriously the view the rating agencies have on us. But once more, it's, at the end of the day, a relative game which is reflecting not only your own shape, but your shape, I would say, relative to the others. If the world goes for a sort of prolonged slow growth, depression, recession, I don't know what, being a single A is going to be being in a very strong position. And, once more, the worst is never certain. Yes, we are seeing the macroeconomic numbers being very, very bad because all the corporations are reacting very proactively, and therefore this is leading to a big drop in their investments, and in their production. But so far, consumer spending has been holding better than expected. So there is a point, I don't know when, but there is a point where a floor is going to be found. So the worst is never certain. On the off-balance sheet items and on the real estate, Denis, do you want to come back to what you said before?
It's really the same question, Nick, because the off-balance sheet unrealized capital gains are relating to real estate. That we don't have unrealized capital gains on loans and to any significant degree. And Etienne has been kind enough to put on the screen slide number 76, which covers real estate. So as I said before, the increase in the unrealized capital gains has been not a function of a reappreciation of the real estate in 2008, but a reduction in tax rates and policyholder participation assumptions. Our portfolio is made of 42% French real estate, 26% Swiss real estate, 11% Belgium, 8% Germany, 8% the US. It's in France, it's 80% commercial. In Switzerland, it's 60% commercial. We have seen prices slightly decrease in 2008. We believe that our values are conservative in Switzerland. The portfolio really has defensive characteristics. Belgium and Germany are markets which have not appreciated a lot in the last several years. So we don't expect them to decrease. In reality, when you look at Belgium, for instance, most of our portfolio is lent to the EU and government-related institutions. So, and Germany has not seen an appreciation of real estate in the past year, so we don't expect a depreciation. So really, probably where we can expect some depreciation in 2009 is on the French portfolio, but to a fairly limited extent because of the way it's been built and its defensive characteristics. So that's really what we have on the real estate side. And U.S. is it's two buildings fully leased in Midtown Manhattan, which have significant unrealized capital gains at this stage, which might come down, but we are not concerned with our real estate portfolio.
Yep.
Hi there, Farouk Hanif from Morgan Stanley. I was just wondering about the rating agency view of your company right now. Firstly, I mean, they give some allowance for double leverage. Could you talk about that and how important that is in your rating? Secondly, how would they treat these prefs if you took them? Second question is, when markets drop and your equity gets squeezed, clearly the amount of hybrid you can take into account also reduces. Have you taken that into account in the sensitivities that you've shown us, and is that a worry on your rating agency side? And last point is, when you show us the market sensitivities, let's say to a 10% drop in equities on earnings, and does that include the impairments too, or is that just the fees and direct impact?
On the rating agency view, I mean, this is clearly a developing subject because rating agencies have had industry views that have changed over time, and we've seen more and more rating actions more recently. As Henri said earlier, we are AA with S&P and Fitch, and I mean, as the market cycle develops, It may be that we would go back to where we were 2 or 3 years ago. So it's something that may happen at some point. They each have different ways to look at rating, and in the rating at capital, they have their own models. In the case of S&P, for example, I think the prefs would be capped out because of the amount of subordinated debt that we have. Moody's would give us some credit, so we have a different treatment with each one. And double leverage, they look at it, but it's not something that is a particular issue for them, because they both rate the group on one hand and the local entities at the other hand. They give us a benefit in the local rating from the group support of a limited number of notches. So each rating agency has its own views, and I cannot comment on their behalf. You could ask them, but clearly we are in a trend where the view of the rating agencies seems to be that we are in a more profound recession than was originally anticipated. And while a year ago they were quite comfortable with the rating of insurance companies, their view is probably slightly more negative now, and we'll see how it develops.
But I think one important point is that it's clear that for the regulators, the preferred are part of the solvency, which is what makes sense.
On the way we've dealt with the sensitivities, because we take into account fully the unrealized capital gain or loss in the calculation of solvency, an impairment is a net positive from a solvency standpoint, because when we impair, we have some tax benefit. Whereas when we have not impaired, we have not taken any tax credit or debit. So those calculations take everything into account.
Yeah. Maybe you raised also a question relative to the haircut on the subordinated debts. What we can say about this is that the haircut is calculated, is limited to 50%. So the availability of subordinated debt is limited to 50% of the requirement. So that means that, and if you go back to the presentation, to the slide number 39 that was presented by Denis, you will notice that, roughly speaking, we have a bit less than 2 billion, which is not available for Solvency I due to this haircut. So that means that the haircut is not calculated on the resources, but on the requirements. So that means that when it mostly depends on the premium in P&C, on the reserves in life. So that means that it has nothing to do except on a marginal basis for the reserves, for the unit-linked reserve, but for the most important part of our requirements, it's independent from the markets.
It's another point where, the insurance rules are tighter than the banking rules, which means that there is more conservatism. Because, quote, we are not a bank, but if we were a bank, the whole sub-debt would be admitted. It's not the case. Yeah. Again.
Really sorry, I just want to completely clarify, because I wasn't sure the answer I got on the impairments was the same one that I asked. But what you're saying is the adjusted earnings sensitivity that you've shown to a 10% drop in markets includes the actual impairments on the equities?
Yes.
Impact of it. Okay, thanks.
Another question? Yeah. So, yep.
Hi, Ralph Hepkin from KBW. Two questions, please. One is on your P&C reserve release. Clearly, you show some willingness to use discretionary powers here and release some of the positive prior year development. Now, in the context of solvency, let's just say equity markets deteriorate materially from here. Can you elaborate on your philosophy? Would you use some of the, let's say, cushion which you hold in reserves in the P&C book deliberately to support solvency? Is that something which you would contemplate? And I can see the smiles already. and if so,
because the question is not politically correct.
Oh, good. Yeah. Okay. That's all fair enough. But And if it was correct, what sort of level of what sort of level of reserves would you be happy with? I know that's not easily quantifiable. And the second one is just to clarify on the off-balance sheet unrealized capital gains on property. This number is presumably not included in the available assets for the purpose of Solvency I calculation. Question mark.
It is included in the solvency calculation. On the P&C reserve release, you give us slightly more discretion than we have. The solvency reserve releases are a function of decisions that are taken locally by the actuaries, and they are not something that we can pull the trigger on at our discretion. But as I said, there is a pattern here where we need. It's normal to have a high cushion at the peak of the cycle, and to reduce this cushion as the cycle deteriorates. And when the cycle improves again, there is a period where you rebuild the reserves and a period where you release some of the excess reserves. And we believe that at this stage we are still very conservatively reserved. That's all I can say at this stage.
Yep.
Hi, Duncan Russell from JP Morgan. First question, could you just talk, I haven't seen anywhere in the presentation what you're carrying the corporate bond portfolio at in aggregate at the gross level before policyholder shareholder split. So could you just give me how much unrealized losses you have on the corporate bond portfolio as of the full year 08, please? Second question is the private equity and hedge funds. You haven't given anywhere how much of that is for shareholders, how much of that is for policyholders, or at least I couldn't see it. Could you give me that, please? And then the third question is just to confirm on the Solvency I calculation. I was having some trouble reconciling it with 07 numbers. So could you just confirm again that you haven't changed anything in terms of how you calculate that in either what's allowable, what's not allowable, or how much of certain things are allowable or not allowable, please?
On the corporate bonds, that's what I said just answering to Blair at the beginning. So that means that we have unrealized capital losses that are in OCI, and if we take the impact of the spreads, it's roughly speaking 5 billion, but this is offset roughly by 5 billion of capital gains. So that's why in the end we are close to zero in the unrealized capital gains on the whole 280 billion fixed income portfolio, including roughly 50% of corporate bonds and 50% of treasury bonds.
No, I was asking for before the policyholder split. You've given me the OCI number, which is not the policyholder.
Before the policyholder split, we could say it's roughly 30% more if you take into account the unrealized losses before policyholder, roughly.
And on the other two questions, I would suggest that you have a call with investor relations, because I don't have this detail with me.
And on the solvency?
Solvency, similarly, I'd like you to take that with IR.
Okay, thanks.
Andrew?
A few questions. How's the portfolios moved so far this year? Because obviously equities are down, but spreads are in. Some of those bank hybrids are going to be looking a little sick. So just wondering how that's looking. Secondly, you put 3 billion or dollars or euros or virtually the same, whatever, out to the States. Where did that come from? And are there now, having done that, fungibility constraints within your operation in terms of cycling capital, particularly to a US operation where the regulator is slightly more stringent? Thirdly, there's some indication that the French regulator may cut you some slack in terms of allowing reserve redundancies to be calculated within the IGD Is that something that you would contemplate, and would that have a material impact on you? And just going back to that question, what I was wondering, what is the corporate bond relative to par, corporate bond portfolio, as opposed to the whole of the fixed interest? That I think was what Duncan was trying to get to.
Okay. So I may comment on the
portfolio movements
so,
and US 3 billion.
Yes. So the movements in the portfolio in January, we don't have a daily view on this. So I can give you only qualitative indications. Yeah, we have both decline in the equity portfolio, which declined by close to 10% in January. The shareholder part is 7 billion, so it's I would say it's 10% of that, 700 million pre-policyholder participation. We have, on the other hand, spreads that have compressed by an amount which would probably be slightly bigger in total. So I don't think this is something that has a big impact overall on the balance sheet. The second question is related to fungibility. Yes, we've sent $3 billion, it was dollars, to the U.S. in 2008. We have a commitment to send another 500 million in 2009 if the RBC ratio was to go below 300%. And we clearly have the means to do that with the cash that is available at the holding company. We have less we have less fungibility available with the various local insurance companies than we had in 2008. We still have some, and we have a significant amount of cash held at the holding company that gives us significant flexibility. Last question on the flexibility that the French supervisor ACAM would give on various aspects. This is this is something that I understand you've heard from one of our French competitors. It's we have an interpretation of this, which is that it is soft. We understand that on a prospective basis, looking at the solvency prospectively, the French supervisor would take into account elements like non-admissible subordinated debt in excess of the maximum, excessive or redundant reserves, and other factors of that nature. But it's not taken into account in the amount that we can publish. So that's our interpretation.
But if they were to do so, only the point on subordinated debt would represent a significant amount.
Yeah, Gérald mentioned 2 billion, so 2 billion is
10 points.
Is 10 points. But that's not, that's not an interpretation of the current rules.
On your last question relative to the price, to the average market price of our corporate bond portfolio, so roughly speaking, we are around 95% on average. It's quite concentrated because most of our bonds are senior bonds, and if we take the senior bonds, we are at roughly 97, and we have only a few subordinated bonds. So that explains why the average is around that 95.
Other questions? Yeah.
Rob Haim from JP Morgan. Sorry, I haven't had a chance to go through the entirety of this, so if there is an answer in the book, I apologize. But Gérald gave us the number for like-EV for the group of 18.6 billion. Is this on the same assumption set of last year of just using the swaps curves without the addition of liquidity and year-end volatility, or have we adjusted that 18.6 for those two items?
No, that's quite clear. So that means that the 18.6 billion that I've mentioned, instead of 31.1 that we've published, it's calculated exactly on a consistent methodology with the 34.8 that we have been publishing 1 year ago. So that means that in terms of volatility, in terms of all the different parameters, that's something absolutely consistent.
No, but, the question was related to liquidity premium in excess of the swap rate and volatility assumption. Point in time versus average.
Okay, the cost of the impact of the liquidity premium that we took, i.e. 50 basis points for Europe, 0 for Japan, and 100 basis points for the US, it brought a bit more than 4 billion in terms of EV.
So let me clear this. If I took the 18.6, I'd have to knock 4 billion to get it to exactly the same basis as last year.
If you believe that the point-in-time estimate of risk-free rate without illiquidity premium is the right measure, yes.
But you should take also into consideration the fact that this has been calculated at an extremely low point in terms of interest rates, and since then, in the US, for example, we recovered something like 60 or 70 basis points. In Europe, we recovered something like 30 basis points. So that's why it's quite relevant to have this type of illiquidity premium.
And on volatility, can you explain what we did?
In volatility, we did exactly the same as last year. So that means that we are taking the long-term implied volatility that is calculated on average on 1 year.
Okay, so you did the same last year.
Exactly.
Question there?
And
I think.
And the average volatility is higher than the September 30th volatility. Sorry.
Yeah, I think my questions have actually been, one of them has just been answered. If I can just, actually it's Tony Silverman at Standard & Poor's Equity Research. On the volatility, what volatility does that mean you are using? Was there some assumption that it would return to a normal level over a period of time? One of your peer groups yesterday did that.
No.
Or was it an average over the past year? And the second question was on the off-balance sheet property, which was 3.4 billion on the slide that was helpfully put up. I was wondering how that compares, how that relates to the 1.8 billion on page 7 of the EV report, which is again, is off-balance sheet capital gains. I don't know if one's before policy shareholder and tax and the other's after.
Okay. Okay. Let's start first with your question on volatilities. If you take the EV report on page 38, so you have all the explanation of what we take in terms of volatility. So as I told you, it's implied volatility of market prices. It's on 5, 10, and 20 years for both equities and swaptions. Just as a matter of explanation of what I said before, if you take, for example, the US, equities volatility is at 28.32%. Last year, we were at 22.4%. On the Eurozone, at 10 years, we are at 29.19%. 1 year ago, we were at 24.6%. And roughly speaking, it's same for swaptions. It's even worse because taking the US 10 years, we're at 16.12%, whereas 1 year ago, we were at 12.7%.
The other question on equity, sorry, real estate gains.
I think we could let that question for a call with investor relations.
Okay, because it will be long. Yeah.
What else? Andrew, another one? Sorry, is there someone in the back of the room or someone on the phone? No.
We have a question from Mrs. Emmanuel Gallas from SocGen. Please go ahead, ma'am.
Hello, good morning. Sorry, good afternoon. Can you hear me?
Yes.
So if I may, 3 questions. First, on slide 47, you You mentioned your sensitivities, and you talk about 1% default on fixed income. Could you remind us versus which level this 1%? A second question. Sorry to come back on the U.S., but we understand that two of your U.S. competitors get some capital relief from local regulator. Did you ask yourself for some capital relief? And more generally speaking, is there any risk the French regulator could change its view on capital needs for the U.S.? And the last question, I think Denis Duverne mentioned that on preferred shares, they potentially would be one-third dilutive versus ordinary shares. Maybe I missed something there. Could you elaborate a little bit there? Thank you.
Okay. On the 1% default assumption, it's a straight assumption. We have assumed that 1% of our corporate bond portfolio would default. So there is no benchmark against that. Just an expectation that a sensitivity if 1% of our corporate bonds was to default. Second question, in the U.S. Yes,
from competitors.
In the U.S., we happen
versus the rest of the world.
we happen to be in the state of New York, which is the most conservative, prudent, protective of policyholders of all the 50 states, and we do not expect any particular capital relief. It is true that some of our U.S. competitors have obtained in some other states capital relief under conditions which have not been made public. And so we don't, there has been some numbers that have been mentioned, but clearly there is not a level playing field in the U.S. because we have different supervisors in each state, but we are regulated by New York. As far as the French regulators are concerned in relation to the U.S., I don't know what you're talking about because the U.S. is applying the U.S. regulation. The French regulators, French supervisors are applying both the French supervisory rules and the European solvency rules on a consolidated basis. They could potentially not allow us to transfer funds to the U.S., but this is not the case at this stage. So I don't have any particular concern on this. On the preference shares, we have just made a calculation of what the dilution would be if we were to issue equity versus preference shares, and our calculation tells us that equity would be 3 times as dilutive of preference shares, or rather that preference shares would be 3 times less dilutive than equity because once we set because the preference shares are not convertible into straight equity, and once we set the rate of a preference shares, it is set. Whereas and there are limits to the amount of dividend that we would pay, which in the draft resolution is 14% of a maximum of 14% of the nominal as an equivalent of interest. Whereas if you issue equity first with a discount, and then the dividend will grow with the earnings. So that's the reason why the dilution is much less severe.
Andrew?
It's Andrew Ritchie from Citadel. Just 2 very quick questions. First of all, could you just clarify, in the 18.6 billion of EV, as it would be on the old basis this year, what was the impact of the fair value of your own debt? And second question, in your capital structure, can you just remind us what bits of your capital structure are loss absorbing? In other words, the perpetuals, and if you were to issue preferreds, would they be loss absorbing capital as well?
Gérald?
Okay. To answer your first question on the fair value of debt, so the fair value of debt under the TNAV method, under the assuming that we would take the TNAV, so that's the old methodology, the mark to market of debt would be 2.9 billion. Where does it come from? You get the answer on page 43 of the. You have a specific appendix on this. It comes from the fact that we have super subordinated debt, and most of these debts have been issued with a spread of 1.5%. Now we are far above this level, and so they all have a market price which is close to 50%. So that explains why you have a surge in the unrealized gain on this debt.
Would preferred be loss absorbing was the second question.
Our debt, our existing debt is not loss absorbing, and the preferred would be loss absorbing, and they would be loss absorbing in proportion of the issuance premium.
Yeah, Andrew.
Andrew Green at Citi again. I just want to follow up on a question I asked earlier. What is the US RBC at December? And then a more general question on your investment philosophy currently. As corporate bonds mature and as net flows come in, are you reinvesting in corporate bonds at the same sort of crediting rates, or have you been moving into govies in the fourth quarter to sort of protect yourself, and is that still the case? So how are you viewing the current spreads? Are you running shy of them or taking them as a big benefit?
On the RBC in the US, it was 329% at year end. And on the reinvestments, Gérald, do you want to comment on that?
We have been extremely cautious in the fourth quarter last year, so that means that we were mostly cash. As you can notice in the presentation, Denis mentioned to you that we had a cash position above 30 billion. Nevertheless, we are investing in corporate bonds, not exclusively. We have, roughly speaking, as I said, 50% in T-bonds, 50% in corporate bonds. We will slightly increase the corporate bonds, and at least we will invest in high-grade corporate bonds, like senior debts from banks and from large corporates. About the spread, you can notice that in January there were some attractive new issues from utilities. And, for example, you have Suez. Suez was at 200 basis points. That's the kind of risk that we can take, and that gives some significant upside in terms of interest rate. In the end, what does it mean? That means that when you reinvest money, you can offset and even be better off than you can offset most of the decline of the risk-free rate.
Roughly, I would say that we are flat in terms of our reinvestment rate is very close to our existing rate right now.
Yep.
Hi, just a couple of Mike Broom from Foxpit. A couple of very quick questions, I hope. I think Gerard said without the liquidity premia, the EV would have been 4 billion lower. Is there any kind of? I'm looking at page. What page am I looking at of the embedded value report? Page 10. The sensitivities on page 10 of the embedded value report. Is there any kind of rough rule of thumb how you get from those sensitivities there to the 4 billion number you mentioned? So that's the first question. And the second question, again, just to clarify, on page, where is it gone? Page 39 of the embedded value report. Second paragraph there, you talk about volatilities, swaption implied volatilities, etc., etc. And you seem to imply you take an average number for the whole year, 2008. I may be totally wrong here, but I vaguely remember last year that was the average for the last 2 weeks or so. No?
No. Okay. I start with your last question. So that's last year it was absolutely consistent with the methodology that we took. It would have done exactly the same. So the volatility level would have been the same last year. So your question, to be sure I understood your question on page 10. Your question is to see if the illiquidity premium has an impact on sensitivities in EV and NBV. Is it right?
Just basically, I was earlier trying to get at the impact of that, the liquidity premium.
Can you take the mic, please?
Sorry. Earlier, I was trying to get at, estimate that 4 billion number, playing around with some of the sensitivities on page 10, and came to a number a bit over 2 billion rather than 4 billion. So I'm just wondering, is going forward, is there a kind of rough rule of thumb how you can use the sensitivities on page 10?
Can we get the mic here in front? Okay, go on.
Well, technically, it's not the same as the sensitivity on the interest rates, because what we do is we add a 50 bips or 50 or 100 bips premium on the curve that we use to project all the flows without changing the value of the assets, which means that it has a consequence as projecting a higher reinvestment rate, those kind of things, getting out of the money on some options, those kind of things. But actually, technically, that's not the same as the interest rate sensitivity.
So there is no way you can rebuild that using the sensitivities as they stand. Okay.
Do we have a question on the phone or not? Yes.
We have a question from Mr. Thomas Zakier from Exane. Please go ahead, sir.
Hi, good afternoon, gentlemen. We start to see some of your competitors doing some goodwill impairment on their most recent acquisitions. Do you see any reason to follow this trend in the coming quarters? And my second question is related to your the view you have on your competitive position regarding the credited rates on life products, especially in continental Europe. Do you think that the rates you're paying currently are attractive enough to keep the commercial momentum? Thank you.
On goodwill impairments, as you have seen, we have not impaired any goodwills at the end of 2008 because we didn't believe it was appropriate to do that. We will review the situation in each of the coming periods, and the question is going to be a judgment as to whether the change in market conditions is something that is going to continue for quite a long time or is temporary. When I look at our most recent acquisitions, in the case of Mexico, I don't see any reason to have any particular concern because this company was not making money when we bought it. It made a little bit of money in the first 6 months, and we expect it to be improving its profitability quite rapidly in the next several years. In the case of Russia, it's a bit different because there was an expectation of high growth of the motor markets in Russia. And even though we have a very profitable business, which is in line with the assumptions, if growth doesn't come back in Russia because oil prices would be permanently depressed, we would have to review the situation. But it's too early to say anything more than that at this stage. In terms of the competition on crediting rates, I suppose that you are asking the question is in relation to France. We have had a policy this year in France which is very consistent with the one of the previous years, which is that we are not the most competitive and never try to be the most competitive. We are among the companies that offer an attractive, a decent rate, which takes into account our financial strengths, the investment income that we have earned with a quite good asset liability management policy, and the level of profitability that we want to give to the shareholders. And in France, in individual life in 2008, we have gained market share because the bancassurers were losing market share. We believe that we have maintained our competitive position overall.
I think the important point today is, for the clients, there is a flight to quality, so I don't think we need to overpay. Is there another question on the phone? No? Thank you. In the room? Yeah.
Yeah, it's Tony Silverman, Standard & Poor's Equity Research. Just to follow up on an earlier question, how is the US built into your, how does the French regulator build the US into your Solvency I required capital?
The US is built exactly the same way as any other business. It's treated as if it was a French business or as if it was an EU business. So the solvency requirement is based on the reserves, and the solvency available is determined at the group consolidated level.
So how, the follow-up question would be, how does what you actually use then doing that relate to the NAIC minimum? Is it something like 1 times or something like 2 times that? Or is it possible to say?
When you look at the addition of reserves and capital in the US system and reserves and capital as determined in our European solvency regime, they are about the same with a gap of something like 500 million. So it's quite close.
Thank you.
Yeah. Blair?
Thanks. Final question from me. Just a bit confused on what the trigger point for doing these prefs is. On the one hand, you said the rating agencies, may downgrade, but presumably not by much, and you wouldn't defend it anyway. You said your solvency margin is well above the 100. Sounds like the regulators allowing for soft factors, which could amount to, I don't know, 2, 3, 4 billion. So, under what circumstances are you going to raise capital, equity or non-equity?
Okay. You remember Greenspan's answer when asked a sort of similar question? I think don't expect us to give us a precise trigger point. There is no reason. We will do it when we feel it's appropriate, if there is a need. If there is a need. At this stage, we don't think there is a need. Okay? So the way you have to look at it is, I think, quite simple. What we are telling you is we are adding an instrument to the toolkit, which is an instrument which can be used in case of necessity, and which is less dilutive than ordinary shares. We also tell you that the mutuals have significant resources and would be ready to go and underwrite that if needed, but that other people could also underwrite that, the market. Therefore, we have these 3 resolutions. When would we use it? I'm not going to go beyond the answer. We will use it if we think we need it the day where we will use it. Point. What are the driving elements? The regulators can ask us for more capital if they become uncomfortable in a sort of crashing world. It's not the case today. So that's it. Okay?
Can I just follow up on that then? How concerned or unconcerned are you about the tangibility of your capital? It's something that's often talked about. It's roughly gone down by 50%, and you're talking about adding, potentially further, non-equity capital to the base, which would potentially increase the leverage for ordinary shareholders.
Yeah. What we've been telling you is also very very simple. It's clear that the margins there are not what they used to be in normal market circumstances, but we are also going through very difficult times. What are the key driving forces? The key driving forces are what are the regulators asking you to have to underwrite your business. That's it. And preferred shares would be admissible to satisfy the regulatory requirements.
This whole discussion about tangible equity is a red herring, frankly, because we've been a company that has made acquisitions over the last 20 years. We have significant amounts of VBI, intangibles, both in the form of VBI, which is a real asset, and goodwill, which is a real asset if we continue to write new business. And frankly, you cannot buy a life company without paying a goodwill unless you buy a runoff, essentially. So this is, I don't think it's really a serious point.
Yep.
Brief question on page 71 of the slides, the ABS stuff. You say level 3 represents about 15%. Now, my memory may again be playing tricks with me, but I think at the half-year stage, in answer to a question rather than in the pack, you said it was 2 or 3% was level 3. I mean, what do you see happening to that going forward?
Sorry, it's a typo. It's 1.5%. It's not 15% for the level 3.
Okay. Thank you.
Thank you for picking it up, because it's a 1.5%. No, c'est pas faux. 1.5 for the overall portfolio and 15 for the ABS. So ABS is 15, 1.5. So sorry, it's not a typo. It's 1.5 for the whole bond portfolio and 15 for the ABS. The number for the half year was about the same. It was 1.4, something like that. So it's not changed much.
Another question? No? No questions on the phone? Good. Ladies and gentlemen, thank you very much.